This podcast was made possible by the kind support of Alvine Capital Management, a London-based specialist investment advisor and placement boutique.
The martial arts instructors that I've had, what they've taught me is put the art in what you do to make it beautiful. So, we talk about martial art, the last word is art. So ultimately, what we find out is it's not really a physical limitation that's your limitation. It's developing a sense of not quitting, keep going, patience, and more importantly, confidence, right? So there are moments in people's lives where you can't run away from. In those situations, the most important thing you should have is a sense of not quitting and keep going and patience. And by training hard, you can gain the confidence that you can overcome a devastating situation.
I'm Aoife Devitt, and welcome to the 50 Faces podcast, a podcast committed to revealing the richness and diversity of the world of investment by focusing on its people and their stories. I'm joined today by Zia Uddin, who is president of Monroe Capital LLC, an asset management firm headquartered in Chicago, which invests in middle market companies in North America through a range of products. Prior to joining Monroe, he focused on middle market private equity investing for most of his career. Currently, he sits on a range of private company boards, as well as on the board of Adherent, a public company. Welcome, Zia. Thanks for joining me today.
Thank you so much. I'm glad to be here and look forward to the next 35 minutes.
Well, great. Let's start by talking about your background. Where did you grow up? What did you study? And how did you end up pursuing a role in the investment world?
Yeah, so I grew up actually in the Chicago area. There's a town out west called Westmont. So I grew up there for a majority of my elementary school, junior high. I did actually move to Indonesia and lived there for a couple of years, as well as South Korea. So I actually graduated high school from Seoul, South Korea, out of an international school there. And then I went to the University of Illinois at Urbana and got my bachelor's degree in finance. And then several years later, went to the University of Chicago and got my graduate degree in 1997. So, I actually started my career coming out of undergrad in management consulting. So back when Anderson was here in Chicago, I joined them, did that for about, I think, 8 or 9 years, and then went into private equity in 1999. So I had my first foray in the principal investing side in 99. And then after private equity, I went into private companies at kind of a C-level position. So COO, CFO, and tried to learn the business from the inside out, and then joined Monroe in 2007.
Well, I can't let hearing about a childhood like that pass without asking a few questions about it, because I also spent some years in Indonesia, but in my professional life. So fascinating place. Did that affect the lens through which you see the world, spending those formative years in quite what might be deemed exotic destinations?
You know what? It is probably the single most significant influence in my upbringing, and I'll tell you why. And today it's a little bit different with the advent of the internet, and people are very connected. But back then, this was kind of pre-internet. The Seoul Olympics were happening when I was living in Korea. And the benefit I had is I was at an international school that had, students from 40, 50 different countries, right? So Finland, Sweden. My best friend in junior high was someone from Sweden. So having a global perspective that early, in the ages of kind of 13 to 16, 12 to 16, hugely important, especially given kind of where the world is now and everything more connected. It definitely helped me kind of gain an appreciation to see other people's points of view, right? So one of the things that I firmly believe is everyone has a perspective, and it's not right or wrong, but if you don't understand people's perspective, it's hard to comment. And most people, I don't fault on anybody, but they haven't lived other places. They haven't lived in other countries. They don't have that exposure. So it's eye-opening to have that. And especially if you have it early on in your life, it, I think, lays the groundwork for a better experience down the road.
Do you think it helped you analyze companies and really assess management and their priorities?
Yeah, I mean, I think from a diligence point of view, I think it's less limited. I mean, being in junior high and high school, I think that part of it was probably not as much. What I will tell you is what you appreciate is the culture aspect of it. And so there is definitely an intertwinement between culture and business practices. And whether you're talking about Japan or Korea or Indonesia or India, the way the culture is, that's interwoven in how they do business. So from that point of view, I'm hugely sensitive to it. And it's helped, I think, considerably while I've been at Monroe. And we fundraise across the world. So for sure, from that perspective, the culture aspect and the people aspect has helped the business. From a diligence and management, I think I was a little bit too young to fully appreciate how that would all pan out. But from a culture and, keeping an eye on what to do and how to act and, what was important for that local culture, that was hugely important.
And let's move to Monroe now. You're at the helm of this firm. What is at the forefront of your mind in today's market landscape?
Yeah, so just for people listening, I mean, currently I'm president of Monroe. We're about a $14 billion asset manager out of Chicago. We're predominantly focused on middle market companies, as you mentioned, particular emphasis on B2B, software, tech, healthcare. I sit on the investment committee and I'm responsible for a lot of the investment selection along with our IC and manage our funds that serve the institutional investors. So, given my day-to-day responsibilities, I spend a lot of time talking to management teams of our portfolio companies, our LPs from across the world. And so going back to your question, I mean, the obvious things that are on the forefront today, which everyone is talking about, is inflation and rising interest rates and the war in Ukraine, all of which I think has us on the precipice of a recession. If not, we're already in one. But, some of these major macroeconomic headwinds, it's really where I focus is on the retaining and recruiting of employees, right? So I spend a lot of time on the talent side. That is important for us, but there are obviously some macro headwinds that are facing the investment environment. But for the day-to-day where Monroe, I think, can add some value is really its people. So the market for talent is arguably as challenging as it's been in my career that I've seen. There's a lot more demand in the financial services market for experienced talent, especially diverse candidates with experience. And, what we're trying to do is build a platform and an institution that'll outlive me and the other senior leaders at the firm. So it's still a people's business. So I spend a lot of time making sure Monroe continues to evolve and becomes an employer of choice for folks that want to hold on to an amazing team and do something with their lives.
And let's go back to the market opportunity, maybe aside from the current backdrop. Why middle market? It's often said in private assets that middle market is where the real opportunity is. Why do you think so?
Yeah. So for those who don't know, the middle market's a massive space, and we're really in the early innings of the consolidation in the market. In the U.S., there are about 200,000 companies that have revenues between 10 million and a billion. So people kind of generally know that stats. In 2021, the last stat I had read, U.S. private equity firms bought about 7,000 companies. So what that basically means is a vast majority of the middle market companies did not transact. So there is a significant amount of white space out of that 200,000. Well, to me, what's more interesting is if you look at those 7,000 PE-backed LBOs, 6,800 had transaction values under 500 million. So that's the area we focus. I mean, we're one of the largest asset managers in the country focused on this segment. And even for us, last year we invested in 61 of these companies. So to make a long story short, the degree of fragmentation is what really creates inefficiencies. And it really allows Monroe to take advantage and to earn what we believe really attractive risk-adjusted returns. So, we generally aren't fans of kind of beta plays where you're buying the market. The middle market is so fragmented, you get paid a premium to roll up your sleeve and dig in and find deals. And that's one of the reasons why we have close to 170 employees managing 14 billion in assets. It's a lot of people, but the market is so inefficient that if you put your head down and execute, I think you can create some significant alpha for investors.
And I don't want to make this podcast too time sensitive because obviously then it loses its value. But just in terms of, we're certainly generally in an inflationary environment and a rising rate environment. I don't think that's going to pinpoint us in early April too much. How does direct lending and private credit in general cope with those kind of environments? How can you expect it to be resilient?
Yeah, so it's interesting. Direct lending's an interesting asset class. I mean, first, virtually all of the investments we make are floating rate in nature. So meaning if interest rates increase, the income on our investments we earn and the returns we provide to investors should increase because everything's floating rate. So that, believe it or not, is a tailwind as interest rates rise. Now, historically, during periods of high inflation, rising interest rates, that's almost always ushered in a recession. So if you think we're headed in a recession, as I do, now's the time to reduce risk in the portfolio for LPs. And what that means for us is you see a lot of clients reducing their exposure to equities and increasing their exposure to first lien senior secured debt products that we offer. So believe it or not, it's somewhat perverse, but when things are chaotic and ugly in the economy, those are generally opportunities to generate high risk adjusted returns if obviously you have the infrastructure, you know what you're doing, you have a track record, all of those obvious things. Obviously, there's stress on the company level, right? So what we want to make sure is we're investing in companies that are not going to be significantly impacted by higher inflation or a recessionary environment, which is, for us, we've been doing this since 2004, the principles prior to that back to 99. So we've been through multiple recessions. And we underwrite every one of our funds to operate in a recessionary environment. So, I think we've built the portfolio and the platform to be defensive, to kind of deal with these types of risks. And that includes industry selection, company-specific selection. But, generally, when things are not so great in a macro environment, direct lenders tend to do okay if you know what you're doing.
And how about ESG factors? There's certainly a rising awareness of ESG risks. And I'm sure you're getting from your clients' side increased demand to indicate where you are of these factors and take account of them. Can you talk about how you integrate?
Yeah, I mean, ESG obviously plays a major factor. I expect that it'll be even more top of mind in the years to come. I think we're in the early stages of what I think is a 20-year period in which ESG is going to be the dominant theme. But generally speaking, when we invest, we're trying to avoid risks that can cause a major step down in value. And that's really the way you lose money as a senior secured lender. So that leads us to avoid some obvious risks like customer concentration or tech risk. But it also means that we can't invest in companies that have major environmental risks or are on the wrong side of changing social norms and expectations, or have a history of treating employees poorly or offering unsafe workplaces for their employees. So we spend a ton of time in our diligence assessing the quality of the management teams, the governance of our borrowers. And for middle market companies in particular, the skill and the stability of the management teams are very important. So we have a low tolerance for teams that have demonstrated a past history of recklessness or poor decision making. The other obvious piece of ESG is reputational risk, right? So both for Monroe itself as well as for our investors. We would hate to see our firm's name in the headlines of lending money to a disreputable company. But what would make it even worse is we're investing on behalf of teachers, firefighters, insurance companies, faith-based institutions, and many other organizations who don't want their money going to companies that are making the world a worse place. So that responsibility we take very seriously. It's not our capital we're investing, right? We're investing it on behalf of all the folks I mentioned. So incorporating ESG into every step of our investment process is a great way to ensure that we look out for our investors and we can look them in the eye every day and say we're doing the right thing.
And just drilling down into a particular aspect of ESG, say the governance aspect around diversity. Can you speak a little bit about your thoughts on the diversity of the investment industry and how it has evolved through the course of your career?
Yeah, so this is, to me, very easy. There's not enough diversity in the investment world. I'm not breaking news to you that the industry is dominated by males, typically white males, who went to a relatively narrow subset of schools and usually worked at one of the same 10 firms after school. It needs to get better, and it is a big part of what we try to focus on at Monroe. I mentioned earlier, I spend a lot of time thinking about our firm's recruiting and culture. And I wish I had the silver bullet to the question on, how do you improve diversity quickly in the investment world? I think the first step is recognizing there's a major issue, right? So I think generally people finally acknowledge that. The second part is making it a priority to hire diverse candidates. And that part, it's easy to say you want a diverse workforce. It's much harder to actively hire employees that don't perhaps have the same college on their resume or have the same set of prior work experience as somebody else interviewing for the same job. That part has to change from a mindset point of view. We as an industry and a society need to realize there are much more important determinants of professional success than where you went to school or what jobs you had previously. And we'll talk about this a little bit later. There are a lot of things that I believe are important that require no talent. You need intellectual curiosity, you need work ethic, you need a diverse worldview, and you need a broad array of life experiences. Those things are just as important, if not as important as, where you got your finance degree from. So, having a diverse workforce isn't just important because we as a society have created structures and systems that made it impossible for everyone to participate in the American dream, and that should be fixed. But it's also having employees that bring different experiences and perspectives to decision making, which my belief results in a much more complete and well-rounded analysis. Because at the end of the day, anyone in the investment world, you're just assessing risk. So the more perspectives you have on that, I think the better the decisions you make.
And in terms of trying to address this balance or this imbalance, how do you think is the right way to go about it in terms of maybe getting the pipeline to be broader, maybe certainly wider net of schools, etc., or through the nurturing once somebody's already in the firm and perhaps coaching and mentoring at that stage?
Yeah, I think it's a combination of both. For sure, the funnel has to increase, right? So, we've had this discussion internally, and for us to increase our diversity hires, you have to not go through the traditional ways of how people traditionally recruited. There are different colleges you can go to. You can have very targeted approaches to increasing that funnel, which is where, at the end of the day, it's a numbers game. So the more candidates you have from a more diverse background and set of colleges that you normally, historically, people probably did not recruit from is obviously a big part of the solution. The other part is what you mentioned in the second half of your statement, which is internally then, once you have diverse candidates, then what are you doing to help them along? And the coaching, the mentoring, and that part of it is equally as important. So, it is something that requires constant vigilance. And, we are, as an industry, really, really far behind. It is embarrassing to talk about, but it is something that needs to get fixed and people need to prioritize it. And, this is part of ESG. And you see this a little bit coming from the LP side, but it doesn't seem as an important topic on the LP side as, I'm just going to pick environmental, for example. So, but these things it's not an issue of one is more important than the other. All of them have to be addressed. But, sourcing candidates from diverse areas and diverse schools, as well as kind of nurturing them and mentoring them through the firm are equally important.
Let's return to some personal reflections now. So you talked about your career path. Were there any setbacks or challenges in there where you've learned lessons that you can share?
Yeah. So, there's a quote, and I don't remember who said it. The quote basically goes, I may probably get it wrong. The problem with the world is that intelligent people are full of doubts, while the stupid ones are full of confidence. So I would tell you, overconfidence is probably the worst quality you can have as an investor. And what I have seen, especially after the GFC, so after 07, 08, is there really hasn't been any stress in the system. And people are, I would say, a little bit overconfident because nothing bad of significance has happened. COVID, believe it or not, is not, to me, a normal event when the government puts $6 trillion in the economy, I think it's a different animal. But I believe that people just are a little bit overconfident. And when you ask me kind of setbacks, challenges, generally, most of what I've seen that hasn't gone exactly as planned where I've been involved, it's been involving bad decisions. And when you have bad decisions, you look at the root cause, and most of the time you're either overconfident in your decision or you have bad data, right? So one of the big things that I believe in is you can only make good decisions if you have good information. And what's challenging in a difficult situation is you don't have perfect information. And where we've run into, or where I've run into issues, is I thought I had all the information, but I didn't. And that led to a wrong conclusion. At the time, I thought it was the right decision, but hindsight being 2020, you find out that you don't have all the information. So, we spend a lot of time on, obviously, all decisions trying to make sure we have all the angles mapped out. But sometimes, it's an imperfect world and you don't have everything.
I just want to pick you up on that point of overconfidence, because it's my sense within the investment industry that there's often an expectation that an advisor or an investor will be confident, will have conviction. And that expectation may come from the client side, it may come from peers. But is it an industry where not being confident or admitting uncertainty, there's a comfort level with that?
Yeah, it's interesting. You're 100% right. There is, and again, maybe it's a stylistic thing for me. When I talk to LPs who give us a lot of money and they ask me a question, sometimes I don't have the answer. And sometimes you say, listen, I don't know for sure, but this is what I think. The difference between that and saying something, you're right. Most people I talk to in the investment professional world are concerned that if they don't come across as confident or sure of the answer, that is a negative. And the fact of the matter is, I think that's wrong. Saying something and saying it with confidence is dangerous. And I think it's a disservice to folks giving you money and folks that you're investing on their behalf, because at the end of the day, there's only one truth, one reality, and you're better off saying, listen, this is what I know, this is what I don't know, but this is why I think and generally people can make their own determination, but for people to come out with such strong conviction, to me, is just dangerous, because you never know. I mean, there's always an error rate. Now, we can argue about if the error rate's justifiable for folks to be that confident, but you're right. People look at it as a sign of weakness if you don't come across with a definitive answer. And sometimes you don't know. And you could be right, you could be wrong, but being definitive when you don't have all the facts, I think is not a good approach in the long run.
It's a very interesting perspective. And looking now at any key people throughout your career, we've mentioned the importance of mentorship earlier. Were there any mentors for you or any key people that you can mention?
Yeah, I mean, obviously in my professional career, my first boss was a gentleman named Dan Broadhurst at Anderson. He was a great guy, very even-keeled, understood that people is what drives performance. So that was something that was important. But, more importantly, he was a partner at the time. I was a junior staff. I mean, he was a guy that had my back, which means a lot when you're a kid, right? So Dan for sure was important. Tom Ablum, who was the GP at the private equity firm I was at, he taught me details matters. I would be amiss to say Ted Koenig at Monroe, the CEO, one of the founders of the firm. I mean, I thought I was pretty tough mentally. He's on a different plane of existence. I mean, words like fail, end, and no have very different meanings to him. In his world, fail means first attempt in learning. End means effort never dies. And no means not now. So, that sort of resilience is important. And then lastly, this is not work related, but, and we'll, I think, talk about it in a few minutes. The martial arts instructors that I've had, what they've taught me is put the art in what you do to make it beautiful. So, we talk about martial art, there's the last word is art. So, we'll talk about that, I'm sure, in a few minutes, but they for sure kind of have had me focus on different aspects as opposed to kind of the traditional Western ideas.
Well, let's jump in now to discuss your martial arts interests, because it seems like it's been a well-developed passion throughout your life. Can you tell us about that and maybe insights that has given you?
Yeah, so this can take a while, but the martial art I practice is called Kendo. So Kendo, Kendo, it means way of the sword. So the concept of Kendo is, if you read the definition, is to discipline the human character through the application of the principles of the sword. So it sounds very esoteric. Like all traditional martial arts, the development of Kendo lasted several centuries. But unlike modern sports, it really incorporated many different influences, and many of them were developed well before modern times. So Kendo developed as a way of practicing swordplay unique to Japan. So its founding was in the samurai warrior caste. But as centuries passed on and warriors became interested in things like poetry, literature, religion, philosophy, that became incorporated in the martial arts. So this mental attitude of, Zen Buddhism. So a lot of the warrior etiquette, and people have this term called Bushido, Kendo grew into something bigger. So I started in 1998. So it's been a long time for me. Back in the day, it used to be part of the elementary school and junior high curriculum in Japan. It was very popular in the 70s and 80s. But if you think about it, what Kendo is Japanese fencing. So how does this apply to kind of your approach to business or managing teams? So in Kendo, you wear equipment, you have a bamboo sword, and it's very hard training. Generally, hard training drains your physical energy. So when you reach a certain point, your body starts sending signals to try to stop you from moving. So your breathing becomes really fast. You can't even step forward. So what happens then is your mental energy takes over your body. And that's really where the real training starts. So in order for you to keep going, you have to use your mental strength. So this idea of your strong will keeps you going. So ultimately, what we find out is it's not really a physical limitation that's your limitation. It's developing a sense of not quitting, keep going, patience, and more importantly, confidence, right? So there are moments in people's lives where you can't run away from. In those situations, the most important thing you should have is a sense of not quitting and keep going and patience. And by training hard, you can gain the confidence that you can overcome, devastating situations. So it's a long-winded way of me kind of trying to tie the two together, but it's not a practical martial arts. It's not a defensive martial arts like karate or aikido or anything like that, but it has definitely a different spin on kind of what the focus should be.
And even if you take nothing from something like that to your professional life, I do think that having a passion that sits side by side with your professional life introduces the balance. So I like to, that for me, the same thing would be long distance running. Moving then to other pieces of wisdom, whether they came from a martial arts instructor or elsewhere. Was there any piece of advice that you've heard throughout your career that you can share, or any creed or motto that you live by?
Yeah, so when we recruit people, especially at the junior level, I look obviously at the resume and I look at kind of what they've been doing. But what I tell folks that are interviewing for Monroe and myself, people think talent matters. And it matters at the tip of the spear. But most people, I think, would be hugely successful if they did a handful of things. So what are those things? Being on time, work ethic, effort, energy, body language, passion, wanting to do more, being prepared, being coachable, your attitude. These are all things that require no talent. So if you have these qualities, then, there's a home at Monroe, right? We can teach up some of the technical skills, but some of these things that I listed off, you either have them or you don't. And those things to me are more important than, hey, do you know what happens with cash flow if accounts receivable goes down? That you can teach somebody. Some of these other things, they are part of somebody's DNA. And so those are the things I tend to look for because we're looking for the best athletes.
And is there any advice that you would have for your younger self?
I would tell you, that's an interesting question. I think I'll use another quote. There is a quote that says, I want you to be nice until it's time not to be nice. And that quote is from Patrick Swayze as a character Dalton in Roadhouse, which is a terrible movie from like the 80s, maybe 90s. And, do the right thing, but there's a time not to be nice. And so be nice when you can, but if you can't, then don't let people kind of go all over you.
Well, I think Roadhouse has got some kind of cult following on Twitter now, so maybe there is some deeper life lesson in there that we all should probably be exploring. Well, thank you so much, Zia. It's been a pleasure speaking with you. You certainly have a rich hinterland, which has really helped us now to understand a little bit the perspective you bring to one of Chicago's most interesting investment propositions. So thank you so much for coming here and sharing your insights with us.
Yeah, thank you so much, and I appreciate you taking the time. It was a lot of fun.
I'm Aoife David. Thank you for listening to the 50 Faces podcast. If you liked what you heard and would like to tune in to hear more inspiring investors and their personal journeys, please subscribe on Apple Podcasts or wherever you get your podcasts. You can find all of our content on the 50 Faces Hub, where you'll find a library of role models, resources, and other solutions to enhance your career.
This podcast is for informational purposes only and should not be construed as investment advice, and all views are personal and should not be attributed to the organisations and affiliations of the host or any guest.